In 1999, the Knicks, with the 15th 1-5 pick in the NBA draft, selected Frederick Weiss, a 7'2" center from France. I will tell you that was a disastrous pick. Just let me tell you the ways that the Knicks whiffed on that. And by the way, he became sort of the first posterized person in all time as one of the greatest dunks in history was done over his head. I mentioned that, Dan, because tonight, that was Vince Carter, by the way. Yeah. Tonight, the San Antonio Spurs are going to pick an equally tall player from France, Wembanyama, who is an absolute, I've watched tape on this guy. It's ridiculous what he does. Now you're saying, what are you, out of your freaking mind? This isn't the ESPN. Oh. No, it's not. Tough shit. But this is Market Call. It's 1 p.m. on the East Coast. I'm Guy Adami. That's Dan Nathan. In just a few minutes, Elizabeth Young from SoFi will be joining us. Do we have Butters today? I hope we do.
We have Butters.
A day without Butters is like a day without sunshine. Butters.
He's got some really good stuff here. Butters obviously spends a lot of time tracking what a lot of the companies in the S&P 500 are doing and saying, and how it relates to other periods of time here. He's got a really interesting data set that we're going to hit on today that we don't spend a lot of time talking about. It'll be great to get Liz's take also on
data
that
set.
What did I say to you yesterday?
Well, hold on. Before we have to just say, today's Market Call, of course, is brought to you by SoFi, Dan. Oh, yeah. Get your money right all in one app. And, of course, our data provider and our sponsor is FactSet, financial data and analytics powered by tomorrow. Now, please continue. I apologize. What did you say to me yesterday?
We were talking yesterday that it was like the third consecutive down day. The NASDAQ was down 1% yesterday. The S&P was down far less. I don't think either one of us was particularly excited about like what we thought would be a follow through. You know why? Because, we are back in that sort of buy the sort of dip mentality. And it's just kind of interesting today when you see, the NASDAQ 100, it's up 50 bips, 0.5% here, and the S&P, is flattish. And we're seeing this kind of ping pong sort of action, like crude oil. We're going to hit that maybe a little later. It's down nearly 5% today, guy. The money center banks are down over 1% across the board here. But then you have, a stock like Amazon up 3% because they're making some announcement in AI. Mm-hmm. It just seems like we're in this bit of a back and forth, a little like rotation. Sooner or later, I think you'll see correlations go higher, especially when you have a VIX that just, on a day like yesterday, where you would have thought the VIX or the VIX-N that tracks the NASDAQ, you would have thought that would have been up, right? On a day where you saw semis getting hit really hard, Tesla down, 3-4% or something like that. And they just weren't. People just don't seem particularly bothered right here.
It's interesting. Sorry about this, Dan. Doug Cass just texted me, or what do they call it when you slide into somebody's DM?
Slid into your DMs.
They call it that.
Yeah.
It's unfortunate. That's just an awkward word. But he said, trivia question, who was the first pick in that draft? And actually, I knew because it was Elton Brand. The only reason I knew that, because Elton Brand, Dan, as you know, grew up in Peekskill, New York, which was the next town over from me in Croton-on-the-Hudson. And he was actually friends with my little sister. I got to know Elton back in the day. He went on to play at Duke University. A lot of people think he might be the best player out of Duke. I'd give a little bit of pushback there. Please continue, Dan. Sorry.
No, I just think that, it's funny. The market is grinding here. Let's throw up the S&P 500 chart for a second. It had that breakout. That August high was the level. Carter kind of made a great point yesterday when he was on Market Call with us that, it really is that kind of cluster from that February 2nd. That's probably where we're going back to. You see that 200-day. It seems so lonely, guy, all the way down there, in and around 4,000 or so. But if you were to draw that uptrend line, from the October lows, that's where it gets. Listen, I just think there's a really good chance of that. Now, you might in the comments, and just so you know, people who are participating today, my daughter Alex was in, or both of my daughters, Alex, were in yesterday. And Alex was looking at the comments as we were doing our Market Call. And after, later on that afternoon, she said, why does everyone like Guy Adami so much more than you? She was wondering why no one likes me. That was a really awkward thing for my
first of all, it's patently false. And
we'll go to the comments soon enough.
We don't rehearse these things, but Dan mentioned, that 200-day moving average is so lonely. That might be one of 3 Police songs I have on my 845 song Spotify playlist. That happens to be a good song. Anyway, I digress. Yes, it is so lonely there, and we've talked about it for a while. When you get these 1-2 standard deviations away from a moving average, especially something as big as the S&P 500, you typically mean correct. Now, look, that could take place as the moving average moves higher. Obviously, that's one way this could resolve itself, or it could take place with a sort of a dramatic move lower. That's the way I think it's going to be reconciled, but we'll see. That's what makes markets. But here we've done the back and fill effectively back to that prior high we saw in August. We'll see what the day holds. But to your point, NASDAQ up a bit, Dow down a bit, S&P unchanged, Russell slightly lower, VIX basically unchanged, slightly higher, more of the same. But this washing machine effect that you were basically alluding to continues. And I think it's really chopping a lot of people up unless you've been sort of steadfast on one side of the boat. I will say this before we bring Elizabeth in. I think the move in the banks is interesting today. Maybe that's something to do with 2s, 10s going out to 1% inversion, something we've talked about for a while. I don't know, but I don't want to use the word ominous, but it's definitely something, Dan, to take a look at.
Well, yeah, and you mentioned this kind of, how many standard deviations away. One thing is, let's just pull up the NASDAQ 100 here really quickly, and you see that breakout. It was right here at 13,770-ish or so. You have that rising 200-day a little bit. It's all the way down there, guy. Talk about lonely. It's all the way down there just below 13,000. But the 50-day, which we don't have up, is right at that breakout level. It's right at that 13,770. So listen, be prepared, people. A check back is coming. And if you listen to Carter at all, who only focuses on the on the technicals, is not particularly worried about the fundamentals here, uncorrected moves like this are very unhealthy, and they have the potential, if they go on for too long, to overshoot to the downside. So 50-day in the breakout level in the NDX, that might be the first stop, especially if it's followed by some sort of fundamental data that does not particularly justify valuations and sentiment turns on a dime, which we know it can do. Guy, let's do it. This is the most exciting time of the week, other than Monday morning when we get to spend our coffee time with EY from SoFi for our Monday on the tape drop. Just bring her in, dude.
Check out the look she's got going. I mean, that is fantastic.
Dude. There she is.
I'm a student of the markets today. Hi, everybody. How are you?
What do they call those? Like cat eye glasses? They're fantastic.
Yeah, they got a little wing. They got a little wing going on. I don't like to wear a lot of eyeliner, so I use glasses for that instead.
Yeah, nor do I. But what I will tell you is, I think it was Yvonne DiCarlo, for you fans back in the day, that played Batwoman. Yeah. And she had similar glasses when she was like Commissioner Gordon's daughter role. She was obviously.
Oh, spoiler alert there, dude. Seriously. I mean, if people are coming into the 50s Batman here, early 60s.
First of all, it wasn't the 50s. Okay.
That's a big spoiler right there. Yeah. And I got to tell you, Liz, when you grew up in Milwaukee, cable TV didn't get there to like 89 or so. So you were probably watching those early 60s Batman, shows on a loop there, huh?
Well, you know what happens when you're a kid? You watch the stuff your parents watch because that's what they put on. So my mom was really into MASH. I've seen a lot of MASH.
I watch MASH every night.
I actually got into the Carol Burnett show. I thought it was the most hysterical thing I'd ever seen as an 8-year-old. So yeah, I don't remember when cable hit Milwaukee, but I do know that the Bronze Fonz remains a legend in that city, and there's a statue of him. So I'm pretty sure that there was some cable going on in my childhood. But either way, 1989, I was 7 years old. I don't think I was too concerned with cable TV.
So wait, Guy, and I'm just going to read this. It's not what I'm saying or what you're saying, but in the chat here, there's a lot of hot for teacher comments. There's a lot of hot librarian comment. I mean, like, this is not me. This is not what I'm saying. This is what your fan, EY from SoFi fan.
And I appreciate that. And
wait a second. I screwed up. Hold on. I apologize. Yvonne DiCarlo was Lily Munster, I guess, on the Munster. So I apologize. But my bad. You see what happens when you get the mice. Please continue.
Anyway, this has nothing to do with vanity. This has everything to do with my eye doctor telling me that I got to take my contacts out once in a while. So here I am in glasses today. This is one of the two models I have.
Amanda's mad at me already. It's 110. You heard us talking about there's not a lot to dissect here over the last couple of days. Obviously, since Friday, Tuesday, Wednesday, today, see what happens. But we've had 3 days in a row. But let's go to your note, because you speak about extremes, and that was a great band, I think, in the 90s. Dan probably saw them a couple times, but let's just bring your note up and get right into it, because we're at some serious market extremes here, and I think we've been saying that for a while.
Yeah, well, and the theme of this note, just so everybody knows where I get my inspo from, my analyst is on jury duty this week, and he got selected as a juror, so he's out there catching the bad guys. So this whole note is a courthouse theme, because him and I are trying to work while he's sitting in the courthouse. It's been a little tricky, but anyway, all rise. Everybody started to participate in this rally, and I wanted to take a check, especially because we're about to approach that 6-month point in the year where we're going to switch over into the second half. And for whatever reason, there's psychological things that happen during that time frame. We're also going to start talking about 2024 earnings, and that's going to become the big story. But I wanted to just do a check, right? How extended have we gotten? Because what happened during this rally is you started to hear everybody get excited. It's a new bull market, blah, 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 blah. We get more and more excited about that. And then we get to the point in the last couple of weeks where you hear more and more people saying, okay, that's enough. That's a bit much. Now it's gone too far. And the big question is, how do you know? How do you know if it's gone too far? What are the extreme measures? And there's a lot of different ways to look at that. But some of the really straightforward ones, obviously, we talk about PE ratios all the time. The S&P PE ratio had been above its 10-year and 15-year average for a while, but now just recently broke above its 5-year average. So it's above all of the long-term averages, which is okay. That's not necessarily as extreme as it's ever been in the past, but I usually have to sit back and ask myself, does the environment allow it to stay there? And I still get stuck on, I don't think it does. A Fed funds rate above 5%, possibility for further tightening, liquidity draining, earnings flat year over year. It just feels like that multiple isn't sustainable. So what does that mean? It means it probably blows off some steam at some point, but that doesn't necessarily mean it has to be this huge drop downward. So then you go through some of the other metrics, and there've been really interesting things that have happened lately, aside from the fact that we've been sort of grinding sideways. There's another chart. We can go to it, or it's a table, actually. I had Mario do this from the courthouse. Basically, what happens after a 15% rally that goes on in a really swift way. So we're defining swift by 3 months or less, okay? So we've got at least a 15% rally in the NASDAQ that happens over a period of 3 months or less. He went back all the way 1971 to present. That first column is just rolling 6-month periods. So average 6-month periods over that entire time frame. That's what you see in returns. Okay, you've got average 6.2%, minimum, so biggest drawdown about 50%, max 71.6%. Then just take out the periods that were after a swift rally. Now look, here's the takeaway. Still positive on average, right? The market still seems to do okay after swift rallies like that, but it does seem to be less than the overall average. And then look at the drawdown. The drawdown that's possible, almost exactly equal to the drawdown over the whole period. And the max that's possible also has a cap on it. So this is just something to kind of put it in perspective. Does the momentum usually continue? Sure, it can, but it does usually lose some steam as you go ahead for the next 6 months.
So Guy, I don't know if you got into the meat of her note, and it's one of the first reads that I do on every Thursday morning, whether Mario's at jury duty or not. And first of all, Mario getting picked for jury duty, what is he, like a hayseed or something like that? Like, it's pretty simple bullets to get out of,
well, and he was an alternate. He got chosen as an alternate. He's like, I won't get chosen. This is going to be fine. And then he's like, oh my God, I got chosen.
Have Mario give me a ring. But okay. Guy, in the meat of her note, it was really great. So she was giving some of this data. It says too far, too fast, ? She goes, but how do we know for sure? That's the fun part. She goes, maybe your definition of fun is different than mine. I mean, this is what Liz is spending her time, not just thinking about titles that are going to really irk you a little bit, but she comes up with fantastic data. And then she just defines what fun is for her in a way that many of our fans probably would not agree.
Yeah. And listen, and on a serious note, it's not easy to do what Elizabeth does every week. And I don't care how many people you have working with you. It's hard to come up with ideas and to try to continue to be sort of topical and edgy and nuanced and all those things, especially given the fact that a lot of what we've been seeing over the last 4 or 5 months is a lot of repetition going on. So again, this is somewhat self-serving, but it also happens to be true. She does extraordinary work. So If you're new to this, you should be following her at Liz Young Stratton, definitely getting her work. Dan, back to you. Sorry.
Yeah, quick question for you, Liz. And it's interesting. You know, we have the benefit of talking to you twice a week on our pods. We obviously talk throughout the week too. And we follow you and we read your notes and stuff. It's interesting that some of the strategists out on the street, big investment houses, and they're kind of quietly throwing the towel in on their cautiousness. I don't want to use the term bearishness. Those S&P earnings estimates or the valuation, the trough valuations, and this and they're kind of doing it without saying it, based on what they think is this newfound AI enthusiasm that's going to start another leg of, CapEx and this and that, or whatever. And I think it's interesting because if you go back and look in the last 20 years or so, usually bears get kind of taken out by like some phony sort of narrative or something that seems like it's going to be an inflection point for the economy. And usually if it's already reflected in the markets, the thing that's driving you crazy and like allowing you to say, uncle, it's not usually the thing, you know what I mean, that makes it happen. I'm just curious, are you recognizing some of that too? And again, I say this where it's a hard job, as Guy just said, you know what I mean? And you have the benefit of, you don't have to deal with a bunch of FAs or a bunch of, you know what I mean, this or whatever. Those some of those strategists are getting, you've been in that seat. It's a hard seat, you know what I mean, when you're off sides a little bit.
Yeah, I empathize, I sympathize with them, the ones that have to face financial advisors every day. I did it for 5 straight years, and they are not a forgiving crowd, as they shouldn't be, right? They're trying to run money and really take care of people's lives and well-being. So it is a tough spot to be, and I completely understand that position. There are a lot of strategists out there that have softened their tone, I would say, over the last month or so. And if people have been listening to me, they'd probably say the same to me. I'm not capitulating. I'm not at a point, and even in the note today, I think the last sentence says something like, I'm still reluctant to flip into bull mode. I'm not capitulating, but I think it is important, even as strategists, even if I'm bearish for the long term, and even if I'm for this cycle, if I'm bearish, because I still think that there has to be the shakeout, and I will maintain that until there's absolutely no evidence otherwise. But the idea of moving from late cycle back into early cycle with nothing painful in between, I don't think computes. So I will stay that way. But I do think it's important as strategists to sometimes look at what's coming in and look at what's going on sentiment wise and say, okay, you know what, in the short term, momentum is a really, really powerful thing. And I'm not going to fight the tide all the time just for the purpose of fighting the tide, right? And I recognize that right now the tide is moving, or at least it was moving, in an upward direction in a really strong way. It might be kind of stuck now at this level, but the reality is that it hasn't moved down in a really strong way. And I think just acknowledging that and saying, you know what, there are buyers out there, even if I'm not one of them, there are buyers out there and they must be seeing something that's getting them excited. To your point about AI, I've said this before, probably on this show and on many other shows, I think it is a theme that we can get excited about. But the thing about themes is that they usually don't execute for, let's say, 2 to 5 years. And everybody that's buying on the AI theme today may not get rewarded on that, or may not be told that they're right about the certain company that they've invested in the next 6 to 12 months. And if you want that kind of gratification of, okay, I got it right, you might not get it. So it's a matter of how long can you hang on to such a high valued stock without getting kind of scared out of it with bumps in the road.
Elizabeth, before we get to yields, you brought another slide, the number of S&P stocks, 500 stocks above the 200-day moving average, which you hear all the time on television, but maybe you could just spend a couple, 30 seconds or so explaining why this is important, because it is important.
Yeah, and then this is another thing, actually, and some of the strategists have done the same thing. So when that line was down in the 40% range, meaning only 40% of S&P 500 companies were trading above their 200-day, I felt like, you know what, this leadership is way too narrow, it's fragile, we need to see it broaden out. And this is how you stay true to yourself as a strategist. Then it started broadening out, right? That 40% turned into 60% pretty quickly. And that's another thing you have to recognize. I had to recognize that the small caps were participating. Other sectors were participating. This number went up. Those are good signs. And then the question becomes, can we hang on to it? Can we go further? So we're still in a good place in the sense that more than 50% of the S&P is above its 200 days. So momentum, that tells me momentum is still supportive and it's moving in that direction. The reason that there's this red shaded bar on there is that's between 80 and 90%. If this were a new bull market, Because if you look at bull markets of the past, in the first year of a bull market, you typically see this line between 80 and 90% and hold on to that 80 and 90% level for the first year. So you want to see that line get up above 80% or at least get close to it and then hang on to it. And that starts to tell you, you know what? I can no longer make this pound the table bear case.
Yeah, I think, and that's why I wanted to bring it up, because we're still significantly lower than where we need to be in order for, again, one of these metrics to start flashing green instead of red. You and I do a lot of time on yields. I'm sure it makes people crazy. Dan talks about it obviously as well, but 2s, 10s in a flash of an eye, 1%. I remember it was last week you tweeted. I think on the Fed day, oh my God, look at this move to 94 basis points. Well, you put out a tweet today, 2s, 10s flirting with 100. It's basically there. I've had so many people text me, email me, talk to me about how it's not nearly as important a metric these days. I asked Steve Leisman about it last night. He wasn't dismissive. I don't want to use that word, but he said there were other curve, inversions that were more important. This obviously is not one. I think, to me, it's extraordinarily important because it speaks to exact problem that's going on. Slower growth in the back end, represented by 10-year yields, inflation being sticky as hell, is manifesting itself in two. And, you can say all you want, but we've been inverted now for the better part of probably 14 or so months, probably longer than that. And historically, that's not a particularly good sign.
No, it's not a good sign. And you can look at the chart and see the timing of, what's happened over history. I actually am thinking about posing a question on Twitter, and it's a serious question, and I would pose it to everybody here too. If you're bullish long-term on the market, or if you do believe that this is a new bull market, and I'm not going to argue, you're entitled to your opinions on that. If you do believe that, where do you see these yield curve inversions going? Where do you see yields going? And how do we get there in a painless way and maintain an equity bull market along that path? This is one of those things that, even if you look at the rest of the way that the equity market is trading, you look at the VIX, you look at whatever you want to look at, earnings are flat, not negative, that kind of thing. You're left with this one little piece that's the head scratcher. And it's a pretty loud signal. This isn't a 10 basis point inversion that's lasted for 3 days, right? We're between 80 and 100 basis points now for months, and we've been inverted for about a year. I mean, that's a meaningful signal. So the question that I continue to come back to is, how do we get out of this? Because usually getting out of something this deep is not painless for the market. And it's tough to see the path from 100 basis points inverted back up to zero with a bull market at the same time.
Mm-hmm.
Yeah, I mean, there's tons of data that tracks, the inversions and what it means for stocks, and what the lag is. It's like 15 months or so before we start seeing recessionary signs. Liz, are there some sectors though? And David Rosenberg, I quoted this guy last night on Fast Money and from Rosenberg Research, and he mentioned that he was citing some data that stocks generally do rally throughout the rate hiking cycle, and it's not until after the cycle ends that we start seeing them come in, and that kind of corresponds with the lag effects and what it means on the economy. Are there sectors, because we just talked about the broadening out, where again, none of us know when this inversion ends, and none of us knows how important, Guy, to your point, that the 210 is for the S&P and for S&P earnings and what it means for the economy. But are there some sectors that you feel comfortable kind of hiding out in this very uncertain time, especially if you feel like some of the things that have gotten the S&P and the NASDAQ to where they are hitting extremes, going back to your note?
Yeah. So, and I think that's what's happening to a lot of strategists and a lot of investors too, is that, okay, what if this is a new bull and I missed it, I'm missing something. People are coming back in and saying, all right, if it is, I don't want to miss the whole thing. So what can I buy? And then you try to answer that question. Well, I don't want to buy the stuff that's up 80% year to date. That doesn't feel like the right entry point. So let me look at some other things that I could buy. If you're a value investor, you look at it and say, all right, what are the sectors that haven't quite participated so far this year that maybe aren't as overvalued? Things like healthcare, right? You could even think about energy, and that would be just straightforward from a hasn't participated this year kind of perspective. Then you can start thinking about some of the cyclicals, but here's the catch. If there's still a possibility, which I think there is a good possibility, that we have a recession or a pullback, of course the cyclicals will get hit. The hope or the idea would be that if they haven't gone up as much as much as the rest of the market, maybe they don't have as much steam to blow off in a downturn. But if you need to dip your toes in the water right now, I think from a defensive perspective, I think healthcare is an okay place to dip your toes in the water. It's kind of boring right now, has trailed for sure year to date, but because it's trailed, maybe not as much to fall down. It's a defensive sector in the large cap space that isn't as rate sensitive, so you don't have that kind of direct volatility on it. And then, you know what? If we do have a recession and the banks get hit pretty hard in it, that's the spot that I would start to enter. And it's going to feel really uncomfortable, but that's the thing that then bounces on the other side, especially as a yield curve uninverts, becomes positive, and you get that NIM tailwind. So you got to think about just kind of the longer term. And in this case, the longer term might just be 12 months down the road. But the idea that, okay, if I enter today, stuff might go down before it goes back up, but maybe it doesn't go down as far as tech and some of the highly valued stuff.
We're going to talk about financials. Jay Rice has a comment. It's interesting. And Jay saying trade price, never in wildest dreams would you think home builders would go up in a rising rate environment, but they are. Of course, we've been saying, I'm wrong all the friggin' time, but one thing we have been saying for the better part of the last year and a half is home builders were actually, you could play them from the long side. And if you look, Pulte Homes, I don't know if we can quickly pull up a chart. Pulte Homes, all-time high. DHI, all-time high. I want to say Toll Brothers is probably the laggard, but my point is, we've actually highlighted this, and it comes down to when Dan asked Elizabeth that question, where can you not hide necessarily, but there are sectors whose supply-demand fundamentals, regardless of all the bullshit going on in other areas, still lend themselves to these stocks going higher, and that's exactly what's been happening in home builders. Anyway,
let's take a look. I want to make one point though about that, and I was thinking because we talked a little bit about this last night on Fast Money, and we had Joe Livornia on, and we were talking about the last piece of the puzzle again is unemployment, right? If we saw, I guess, in almost every time in the last 80 years when unemployment has risen 50 basis points off of a low, a recession has followed, and the one thing I would say is that if we do see unemployment above 4%, I'm not so sure. And if we do see rates higher for longer, that you want to be entering new positions here, even though that these stocks, are very cheap, the home builders. I just think that you have been on this trade. And Danny Moses has been talking about it. And Liz, you've been talking about it. It's not something I know a whole heck of a lot about, but I don't think you'd want to be piling into them here just as we're basically going to come off 70-year lows in unemployment. And you know what I mean? Like that's my only 2 cents on that, I guess.
No, I think that's fair. There's going to be a point clearly where you want to pull the ripcord, and you're going to be early, but it's better to be early than late, especially with these things because they do move on a dime. Let's take a look at financials because something we talked about yesterday, and we're going to talk about it a little bit today. Not trading again, I don't want to make a big deal out of one day, but not trading particularly well here. We can throw up a chart. The regional banks seemingly turning again. I don't want to make a huge deal out of it, but you can look at it and see. We had that bounce off those May lows. That makes sense. That was sort of the crescendo of the bad news. Does this concern, Elizabeth, you at all, or is this just sort of noise?
I think it's too short term to really say anything. There haven't been accompanying headlines that have, the picture hasn't necessarily changed. There was kind of a rally. This could just be kind of a give back of that. But I don't know that it's over yet, right? I don't know that the problems have been solved necessarily. And there's a lot of people out there, self included, who have still said something's going on in the credit market. It's too quiet. Something's going to happen in the credit market. And my sense would be that banks obviously get hit by credit. So we'll see if that materializes or not. I don't know that we're going to see the same type of headline again that we saw in March, though. And especially if we continue to have fear in the markets. If fear comes back in, recession fear comes back in, right? You're going to see yields go down again and those types of things rally. So some of this is going to change that mark-to-market problem that the regional banks had. And I think we've sort of stemmed the bleeding on deposits and the fear that occurred in March for that. So I don't think we're going to get the same set of headlines, but I don't think necessarily that the banking sector is out of the woods entirely. I'm just not entirely sure because we know that that's an issue. That's how this always works. Because we know that that's a vulnerability. Maybe it won't be the thing. Maybe it'll be the thing that none of us expected. It'll be an outside event. I still think it'll be a corporate event, but it'll be a completely different sector or something that maybe is related, but that we completely didn't see coming.
It's funny, and I don't disagree with that either. And the longer that we've had to kind of contemplate what actually went down and the extraordinary measures that the FDIC, the Treasury, everybody took to kind of make sure this wasn't a systemic sort of thing. I think that if you see the KRE retesting, those lows that down there near 35, you probably start dollar cost averaging all the way down towards 30, which is basically the pandemic lows, and you will find some unusual values in there. Another one though, and it might be to the benefit of the large money centers. Look at this JP Morgan chart. I mean, it is really hard to shake a stick at this thing. Okay. Meaning, like, look at this. It's back up towards those highs right before the regional banking thing, baby with the bathwater thrown out. You see that uptrend. It's held it like a boss here. I mean, if it goes back to that uptrend, or that uptrend basically aligns with this 200-day moving average, these are going to be the first sector to report in I think mid-July or so. That's the one. I mean, it filled in that gap. You know what I mean? And then it made a move back to the prior highs. Guys, thought on that guy on that chart really quickly, because it's a pretty good looking chart.
I know Doug's watching and listening. Carter pointed this out as well, but you can go back 5 years and you still have a potential for this massive head and shoulders top in JP Morgan. Nothing's really changed. And you're right. I mean, we did bounce off the lows from the spring, probably correctly so in JP Morgan, because they obviously were the winner to all of this. But something I've said for a while, they're going to win to what's going on with the regionals, but what's happening in the environment is going to be tremendous headwinds for all of these banks. Their ability to earn, their earnings ability is going to be diminished for a myriad of different reasons. So the multiple you pay for them should theoretically be lower. And it's still probably, although not at a peak multiple in terms of price to book, it's still expensive. So I look at this and say, a test of this uptrend line I think is inevitable. Probably comes in around 138-ish, and then we'll see if we can get to the 200-day moving average. But I don't think the banks look all that attractive in the current environment. That's just me. You know what time it is, though, Dan?
All right, let's do this here. Not only do we get EY from SoFi on Thursdays on Market Call, but we also get a preview of John Butters' earnings insight.
Hold on, people. Wait a second.
Friday
Stop. You know what time it is?
Yep, there it is.
In the comments, please.
All right, there
Hashtag Butters. Anyway,
Hashtag Butters. All right, so John Butters, he's got a note coming out tomorrow morning. And what I thought was really interesting about this is that oftentimes we're tracking a lot of the work like that Liz just did in her note about valuations and where they are relative to different periods in history and different interest rates, environments and that sort of thing. But right now, and a lot of people push back on this one, Liz, and I'd love to get your take on this. He's taking a look at the amount of buy ratings by sell-side analysts in the S&P 500. Now, a lot of folks will tell you, who cares what some analyst rates a stock over there at some big investment bank? Because we know that they get paid by investment banking fees, so they want to have buy ratings on stocks, so they get looks on deals and this, that, whatever. And then they also have to be able to sell stocks that they are favorable on to their clients and, the like, and this, that, whatever. I find all this really interesting from just a sentiment standpoint. Okay, so just let's go over some of his data right here. Nearly 55% of ratings of the S&P 500 stocks are buy ratings. That percentage is above the 5-year average of 54%, so not much there. At the sector level, the energy, 64%, and communication services, 62%. And we know communication services, some of those much-loved technology stocks here, have the highest percentage of buy ratings. Since hitting a bottom at the end of Feb 2023, the percentage of buy ratings has increased over the past 4 months. 10 of 11 sectors have seen an increase of buys ratings since the Feb 2023, led by the financials to 53% from 47. So financials have improved a little bit. Liz, thoughts from first a sentiment standpoint, tracking this sort of data, is it important to you?
I mean, yes, it's important. Also, let's point out that we're talking about tiny little movements in these percentages, right? So it's above average, but it's above average by less than 1 percentage point. So here's the thing. Analysts are not immune to sentiment. Analysts are not immune to price momentum. And as things come down, they're going to sharpen their pencils and go back and say, okay, is this a falling knife? Did I miss something? And there's always going to be multiple inputs into an analyst's rating. And most of which are them modeling out some kind of financial statement, which would be the fundamentals of the company, the health of the company, the growth expectations, all the assumptions that they're going to put into that and the conversations that they've had with management. Then there's an element that's valuation based. So as things came down in March, probably started to look more attractive from a valuation perspective. And then you see momentum turn. So over the last 4 months, it's been tough, especially, I mean, strategists alike, right? It's been tough to look at that momentum and say, nope, still not going well, because it has been going pretty well in the market for a number of sectors. So I don't think that it should be a huge surprise that in a first half of the year where we've seen a ridiculous rally in certain names and a change in sentiment that's market-based, that we see an increase in buy ratings. Similarly, that if we have a huge correction that starts in the beginning of July and goes on for a few months, I'm willing to bet that very quickly there will be an increase in sell ratings by fall. So nobody's immune to this stuff. And that's what makes this industry and being an investor so interesting. Again, maybe my definition of fun, not anybody else's definition of fun, but the idea that whether, I don't care how much you know about it, I don't care how long you've been doing it or how many spreadsheets you've got, you're not immune to the shift in sentiment and the shift in price.
That's something that Doug Cass says as well. A lot of people, talk about how price has a way of changing opinions, and I get it. And again, to Elizabeth's point, nobody's immune for that sector of people specifically. I mean, you think about the stress they're under, especially if they've been negative with the market going higher. It's incredible pressure to get on the right side of the boat. The pressure is not equally bad as when you're bullish and things are going down. It's just the way that markets work. But that's it. CG, by the way, if you can pull this up, I want to hire Guy Adami to do my voicemail message. You don't got to hire me. I'll do it. But I'll tell a funny story, Dan, before we get out of here. When I was a freshman in high school, our JV coach was new to Croton. His name was Nick Murphy. I love this man. Actually, there'll be a series of pages in my book about Nick. But when you called his house to find him, his answering machine said, and this is one of my favorite things of all time. This was his voice message. Hey, it's Nick. Make it happen at the tone. And I just love that. Make it happen at the tone. I don't know what it means. I didn't know what it meant when I was 17. I don't know what it means when I'm 59, but I love it, Dan Nathan. Back to you.
All right. There was one thing I just wanted to comment on this, Liz, and get your sense. So Jim Cramer has a investment club, and I got an email. I kind of randomly. I'm not in the investment club, but I like to hear what Jim has to say. I think he usually has a good finger on the pulse of sentiment. So they've been calling, and I'm not trying to get you exercise, guy. They've been calling these big.
Don't do it. I got to. Please don't even say it because it's going to piss me off. And I woke up in a really good mood. You got me that T-shirt with Damone on it, and I'm telling you. It's Thursday. I'm happy. Yeah. We got Yankee baseball tonight. The Mets are 6 games under 500. Like, everything's good. If you're going to say something and my whole car ride in, I'm going to be pissed. So don't do it. I'll get off and you guys can talk about it yourselves, but don't do it because everybody wants to come up with the new great, and I just don't want to fucking hear it. Sorry.
So the last point was in the movie, only Tesla, Yul Brynner, and NVIDIA, Steve McQueen.
Okay, you did it anyway.
That's all I'm saying. All right. So I thought that was really interesting. So it was talking about, has this group of stocks, have they possibly topped out a little bit? And yesterday was kind of interesting action. Today, they're back up. Who knows? I do think it's interesting, Guy, that Tesla downgraded by a bull at Morgan Stanley, Adam Jonas. It was downgraded yesterday at Barclays and was down a lot. Today, it's up 1%. So again, I guess my point is that, the last battle in this market are obviously going to be NVIDIA and Tesla, two stocks very near $1 trillion in market cap.
Yul Brynner survived. Steve McQueen survived. Yeah. And the good-looking kid who grew up a farmer but joined the Seven, he was the last member of the Magnificent Seven. He survived, but instead of riding off with Steve McQueen and Yul Brynner, he stayed behind and married the local farm girl. Beautiful ending. The other 4 of the 7 died, specifically Robert Vaughn. I want to say Charles Bronson and James Coburn. I can't name the other one, but that's a great effing poll by me. Nice job.
Wait, I gotta make a shout out real quick. Somebody put in the comments that there's a festival. It's called Summerfest. It starts today in Milwaukee. I believe it's still the largest music festival in the world. You buy a ticket to get in the gate. There's free stages along like a mile stretch on the lakefront. Just music for days. And then there's one stage where you have to buy like a headliner ticket. But it is the coolest festival if anybody ever goes to Milwaukee around this time of year. And then you've got fireworks You can sit on the rocks at the lake and watch the fireworks on July 3rd, which also just happens to be the birthday of myself and Tom Cruise. And it's a wonderful fireworks show. And it's like bookended by music and good beer and fried food. And it's amazing. Everybody should go. Get yourself to Milwaukee. It starts today. Usually runs for like 2 weeks, I think.
It is.
Somebody in the comments just said, these guys are so old. It's comical. Radio's dead. It's 2023. Yeah. I can't argue with you. I'm old. But that's it. And listen, check it. If you're out in the Milwaukee area, yeah, go sit on a rock and watch some fun. What the hell else is there to do?
Wait, Guy, we got tomorrow. Tomorrow, we're going to do a very special market call at 11 a.m. We're going to
Travis McGee.
Yeah. He's the head derivatives strategist at crypto.com. Travis has been a long time friend of yours. Really, I think a really, really smart market mind. I've gotten to know him over the last few years, and we're going to talk a little crypto, and crypto's had a heck of a run, but we're also going to talk macro, and we're gonna trade some other stuff here, Guy, right? So that's
going to be fun. Travis is an excellent. He also happens to be the best looking of the three. That picture of me is freaky as hell. Somebody airbrushed the shit out of that. It probably was Amanda. I'll have to talk to her offline. So we're going to sit on some rocks. We're going to watch some fireworks, drink some shitty beer, have a ball in the state of Wisconsin, and see what the future holds. But that's it for today's market call. I want to thank Elizabeth Young. That's EY from SoFi. The audience always, Amanda, Jacob, Rafus, everybody back at headquarters, as they say. Our sponsors, SoFi. Dan, get your money right all in one app. Of course, FactSet Financial Data and Analytics, powered by Tomorrow. As Dan said, we're back tomorrow with a special drop with Travis McGee. 5,000 people.
Yep.